This is Facility Science Podcast number 2. I am Jason Doolittle, and today I'm talking about real estate leases. And I want to make it clear right up front here that I'm not a real estate expert or a lease expert or a finance expert or any of those things. I'm just sharing with you some things I've learned about this particular topic over the years. So you should definitely consult with the relevant qualified people and et cetera and so forth when preparing to enter into a lease. I'm going to define and hopefully clarify some terminology related to real estate leases, but it's important to understand that a lot of these terms are kind of fuzzy and don't necessarily have strict, consistent definitions. So in general, whatever language anyone uses to describe a lease, the only terms that really matter are the ones defined in the lease contract that you actually sign. Okay, so a real estate lease is a contractual arrangement with two parties: the lessee, that's the user of the property, also known as the tenant, and the lessor, that's usually the owner of the property or someone who otherwise controls the property, and this person is sometimes called the landlord. And the arrangement is that the lessee gets to use the property in return for paying the lessor some amount of money as rent on the land or the building or some part of the building. Now, leases are often described using terminology that references the relative level of responsibility assigned to the landlord and the tenant. So in some leases, the landlord just collects the rent and has no other responsibility. And in other leases, the landlord would take care of everything except running the tenant business and everything in between that. And so here's some of that terminology. We'll start at what's called a full service lease. In this case, the rent payment includes everything, including the property taxes, the insurance, maintenance, janitorial service, garbage removal, the utilities, so water and power, and also often building out the space for the tenant's use as part of the initial agreement. And this type of lease is generally found in multi-tenant office buildings. This type of lease allows the tenant to just run their business and not have to put any effort into actually operating the building, but in exchange for paying a higher rent so that the landlord, the building owner, can then cover those expenses out of the rent. Next, we have two terms that contrast each other, and these two terms are a net lease and a gross lease. So in a gross lease situation, the tenant pays the landlord for the full costs of operating the property, and then the landlord actually takes care of the property. While in a net lease, the tenant pays some portion of those operating expenses directly, so before they pay the landlord, and then pays the landlord after those expenses are covered. So they pay the landlord a net amount, an amount minus some expenses already taken care of by the tenant. Now, there's some variation in the use of the term gross lease. Some people would consider a gross lease to be equivalent to a full service lease, but then others would differentiate between the two. And to kind of get an idea of that, the general categories of real estate expenses or real estate operating expenses are insurance on the property, property taxes, and maintenance. So in a gross lease, the landlord pays for these three things, insurance, taxes, and maintenance, out of the rent payment. So then the question is, are things like utilities and janitorial service, are these real estate expenses? So are these expenses that go to operating the property, or are they expenses that are related to the cost of operating the business? And really, they're kind of both. So in a full service lease, in an office building, the landlord almost always pays for these things, the janitorial service and utilities and things like that. But in a single tenant building, for example, the tenant might receive and pay the utility bills directly, but still have what could be considered a gross lease because the landlord pays for the taxes and the insurance and maintenance on the property. So again, usage of this term varies. Now, in contrast to the gross lease is the net lease. In this scenario, the tenant covers some of the costs of operating the property and then pays the landlord after those costs or those expenses are covered. And often when talking about a net lease, we'll talk about a single net or double net or triple net lease. And so the 1, 2, or 3 things referred to by single, double, or triple are the three categories of expenses I mentioned earlier, that being the taxes, insurance, and maintenance. So in a single net lease, the tenant would pay the property taxes and then make a rent payment minus the amount of the taxes, so net taxes. In a double net lease, the tenant pays for property taxes and insurance on the property. And in a triple net lease, the tenant pays for taxes, insurance, and maintenance. So in a triple net lease, the rent payment to the landlord only includes the base amount the tenant is paying for use of the property, because all the expenses of actually operating the property are covered by the tenant. Now, going maybe a step further, we have what's called a ground lease. In this instance, the tenant leases only the land, the ground, and then they would build and operate their own building. And a consequence of this is that when the lease term is over, the landowner usually would now own the building because it's on their land. And there are various, tax and cash flow reasons to do this. And then the lease would obviously be structured in a way that makes sense for the tenant to do this, to build their own building and then give it away at the end of the lease term. Next up, we have what's called a bondable lease, or sometimes bond lease. This is sometimes called an absolute triple net lease or a hell or high water lease. In this type of lease, the tenant is responsible for every conceivable cost of operating the property, including complete destruction of the building and property and any event that would even prevent the tenant from continuing to operate their business at that property. And also, the tenant typically can't terminate the lease for any reason. So whatever happens, the tenant is on the hook for the full amount of all the lease payments for the full term of the lease in the contract. And to understand why this kind of lease exists, or why it's called bondable, what's the motivation of this thing, is to think of it from the point of view of the landlord, which in this case is really an investor or group of investors. And what the objective is of the owner, the building owner, the landlord in a bond lease, is to put some money into a project and then get a certain rate of return on their money. And if you think of what a bond is something that you buy a bond from somebody, so they have the money, and then after some period of time, you get your money back plus some percentage. And so the landlord in a bondable lease is not really interested in owning or operating real estate necessarily. All they're interested in is getting a rate of return on their money. And since in order to get that rate of return, regardless of what happens on the property, they need to make sure that they have a tenant in the building that has the ability, or at least a strong belief that they'll have the ability to pay the whole lease amount for the entire term, regardless of what happens at that property. So these are going to be large businesses with good credit, maybe that operate in a lot of areas. So this one particular property isn't going to make or break their business. And so what'll happen is an investor who wants to get into a lease situation like this will look for a property and a tenant that satisfies these requirements, and then put together a deal where they're gonna put money into maybe build a building, maybe retrofit a building, prepare the property, however, get the tenant into the property, and then sort of just collect their rent payments and not otherwise worry about what happens on the property. Now, from the tenant's point of view, the tenant's agreeing to basically be on the hook for this, where no matter what happens, they're paying the whole thing. And one of the benefits of that to the tenant is they can operate on the property without really any oversight from the landlord. The landlord doesn't actually care what happens on the property as long as they get their bond paid back with their rate of return. And another thing that can happen in this kind of situation is, since the landlord's objective is just to make their percentage, they're going to they're going to set the rent payment, not necessarily based on what the market is for that particular property or what they could otherwise get if they had a different tenant. They're going to set it based on how much money they put in plus their percentage amortized over the term of the lease. And so the tenant may potentially get, from a rent perspective, a fairly good deal on their rent if the situation is such that their lease payments might end up being lower than they would be in a different type of lease. And this can be kind of complicated, kind of outside of my area. So we'll call the details of this kind of bondable lease outside the scope of this podcast here. All right, next we have a concept called SNDA, and this stands for subordination, that's the S, non-disturbance, that's the ND, and attornment, that's the A. And this is some language that will be in a lease agreement, or some language that you'd want in a lease agreement. So there'll be a clause for each of these things. And so subordination means that the tenant agrees to take a lower interest in the property than some third-party lender. So what does that mean? Imagine you enter a lease with the owner of a property. At this point, the owner has rights to the property, obviously, because they own it. And you also have rights to the property because of the lease agreement you've made with the owner. And that's as long as you satisfy your obligations under the lease. You have rights to the property. Now imagine that later, the owner borrows some money using the property that you're occupying and using as collateral for the loan. So in other words, they mortgage the property. Now, if the owner doesn't pay back the money, the lender, that's the bank, now has rights to the property as well. And since you as the tenant don't have any kind of agreement with the bank, and you established your rights to the property before the bank did, you could conceivably prevent the bank from recovering its investment if there's some kind of conflict between what you want to do with the property and what the bank does, because you both have rights, but your rights came first. So that can cause a problem with the bank. So what subordination means is that you'll put the new lender's rights above yours to prevent this sort of conflict. And a lender typically won't even get involved in a leased property without a subordination clause. And a smart landlord, knowing this, knowing they may want to borrow money against the property, won't even offer a lease without one. So it's almost always the case, if you're dealing with an experienced landlord, that you're going to have to sign a lease with a subordination clause in it. Now, the subordination creates another conflict. So the tenant, that's you if you're leasing the building, has basically agreed that, among other things, the bank can evict them from the property if the landlord fails to pay the loan. And this is obviously not a good situation for the tenant. So in return for agreeing to subordination, the tenant would want what's called non-disturbance. That's the ND in SNDA, non-disturbance. Non-disturbance means that the tenant will be able to continue to use the property in the event the lender has to take over the property. And the exact extent of non-disturbance would need to be specified or negotiated. What I mean by this is that the question is, would the lender be obligated to satisfy all the landlord's obligations under the lease, or simply not evicting the tenant enough to satisfy non-disturbance, or is it something in between? So that's non-disturbance, which is the ND and SNDA. And then the last piece of this puzzle is attornment. ATTORNMENT. Attornment means that if ownership of the property changes, the tenant agrees to recognize the new owner as the landlord and continue to satisfy the tenant's obligations under the lease for the full term of the lease. And that's SNDA, so subordination, non-disturbance, and attornment. All right, next up we have the sale and leaseback, or sometimes just called leaseback. And this is the situation when a company sells a building they own, and either they own it outright or they financed it, and then leases it back from the buyer. And this is very common in corporate real estate, and it can be confusing to people who aren't involved in corporate finance or accounting. Why would you sell a building that has no payments, or that you'll own after you make payments, and then start making payments on it if you already owned it, or keep making payments on it, but then you don't get to own it at the end? Why would you want to do this? And the main reason businesses do this, to my understanding, and especially if they do have substantial equity in the property, is to finance the growth of their business. So most businesses don't have owning real estate as one of the goals of their business. So it doesn't make sense to tie up a non-trivial portion of the company's wealth in real estate. And the bet that they're making is that by taking the money out of the property and investing it into growing the business, the increased revenue will outpace the cost of the lease in the long run. Now, another reason a business might sell a building, especially one with a large loan on it, is to remove the debt from their balance sheet to make the financial state of the business look better. So even though their cash flow situation is the same, they're still committing the same amount, whether it's a loan, mortgage loan, or a lease. They now don't have that large debt of the building on their balance sheet. And in some of these cases, some of the way these deals have been structured in the past, the building might even return to the business at the end of the lease. So it's kind of like a lease to own situation. And because this can kind of start to border on dishonest accounting when a company just tries to recharacterize debt to make the company look better on paper without actually changing their situation. Partly because of this type of maybe accounting shenanigans, the accounting rules have been changed in recent years to require many types of leases to be reported as debt on a business's balance sheet, which makes sense because from an asset to liability point of view, a loan offset by the asset of a company's real estate isn't very much different than a lease commitment offset by that same asset. And the details of this are outside the scope of this podcast, by which I mean to say it's kind of complicated and not my area. If you're interested, there's a link to these new accounting rules in the podcast notes, facilityscience.com/podcast. It's a place to go for that. Okay, so that's kind of the general lease terminology. Now I want to get into some facilities-related issues that might arise when you're actually operating in a leased property. So in no particular order. First, we have a few issues you might encounter in a full-service lease. So as I said before, full-service leases are most common in office buildings, and these buildings often have normal business hours or operating hours. So what if you have multiple shifts or otherwise need to use the building after hours? These are buildings where you probably access your space through common entrances and common areas not controlled by you, hallways and stairwells and elevators and outer doors and all that stuff. So you need to arrange, before you actually get into a lease agreement, you need to arrange after hours access to the building for your employees. Another issue with after hours use is that operators of many of these buildings have things, for example, like automatic setbacks programmed into their HVAC control systems to save energy. So if they're cooling the space, they'll raise the temperature in that space to save energy when no one's generally occupying the space. And if you do have people occupying the space after hours, this might make your space uncomfortable or even unusable. So during the lease negotiations, you should find a resolution for these types of after hours issues. And in the case of the HVAC setbacks, this might include something like an adjustment in your rent to accommodate the extra cost of running the systems after hours, or even sometimes installing separate HVAC equipment in your space that then you would operate and incur the expenses of using. So also, if you have a full service lease, you need to have some recourse when you don't get the expected level of service from the landlord. So first, you need to actually have a service level agreement attached to the lease so that your expectations and the landlord's expectations are aligned with each other. And you would also then want a clause that allows for reimbursement of costs if for some reason you have to cover some of the landlord's costs to keep your business running, if the building management is not responsive. And this would be true not only for a full service lease, but for any lease that includes maintenance or other services provided by the landlord. All right, another issue in potentially a full service lease situation is if you, for some reason, envision that you might change the use of the space in the future. Say, for example, you have an office space that's sparsely populated, and later on you want to change it to maybe like a densely populated call center type of space. So that would maybe multiply your employees by 10 or 20 or 30 times, depending on how dense the space is used. And so that would increase the traffic through the building from your employees. That would increase the use of utilities in the space. And so if you envision that type of possibility, you might check with the building management before you enter into lease. So what if for some reason we need to change our use of the space? Another example would be if, again, you have a sparsely populated office space that then you want to convert into some type of production space. So you want to install some equipment in there and do, rather than office work, do some type of production work, would that be allowed in a building like this? And depending on the building, it may or may not be. Depending on the process you're doing, it may or may not be. So that's a thing to be aware of when entering into a lease. If you have in your particular business experience where you might end up wanting to change the use of the space from the original purpose that you stated when you were actually setting up the lease agreement. All right, now let's talk about repair and maintenance in a net lease, so a lease net maintenance. So on a net maintenance lease, this is a lease where the tenant is responsible for maintenance on the property. You need to make sure it's very clear who is responsible for what maintenance. So obviously, if you're responsible for maintenance, things like a leaky faucet or a hole in the wall or kind of normal wear and tear use on the building, that would be obviously the tenant's responsibility. But there's other things that, depending on the lifespan of the thing and the length of the lease term, that may be a little bit of a gray area. So for example, parking lot paving or roof replacement, these are things that can last tens of years. And so if you have a relatively short-term lease, but you're responsible for maintenance, what if a few years into your lease, the roof needs to be replaced, or the parking lot needs to be repaved, or the elevator needs to be replaced, or something like that? If you don't make it clear up front who's responsible for that, you might have a situation where you're going to be in conflict with the landlord, and it's going to be hard on your business to cover that expense, but the landlord's going to say, hey, you agreed that you would cover maintenance on the property. So that's the kind of thing you want to make clear up front. Who's responsible for exactly what? So what does maintenance mean in the case of a net maintenance lease? Because like I said before, these terms are fuzzy, and the details in the lease agreement is actually what matters here. All right, next up we have legal compliance. So pretty much no matter where your building is, there's going to be some regulations, some laws that your building has to comply with in order for that building to be occupiable, for you to be able to operate your business there. And these are things like earthquake or hurricane or flood standards, or ADA compliance, so accessibility for people with disabilities, or fire sprinklers, or asbestos, things like that, where if you don't have all these things taken care of, you can potentially be fined or have the building shut down, and you won't be able to operate there. And in general, you would want for the landlord to warrant that the building is in compliance with whatever are the appropriate legal standards in your area, and also potentially future compliance. So if the law were to change, is the cost of bringing the building up to the new standard, whose responsibility is that? That should be laid out in the lease contract. And then if the tenant has some particular use, so some specialized use that has additional requirements, maybe that would be the tenant's responsibility to take care of. So the landlord might say, for the general standard of this type of property in the area, it's warranted to be in compliance. But if the tenant has a special case, then the tenant can then incur the cost of bringing a particular part of the building up to a particular standard for their particular use. And the details of who's responsible for what can be negotiated and should be included in the lease. But you would at least want that initially when you move into the building, when you take control of the building from the landlord, that you are moving into a building that does comply with the appropriate laws. All right, now another issue is the idea of tenant improvements. So sometimes you're going to move into a property and there'll be some provision to get the building into the state that's required by your business. And often in a situation, the part of the lease agreement will be that the landlord is going to agree to bring the property into a state that your business can use it. This is often done with either allowance. So they'll say you can spend a certain amount of money in the space or in the property to get the property ready for your use, and that'll be included in the lease payments. Or the other thing is what's called turnkey, and that's in the case where they're going to set up a plan with you, and then they're going to take care of whatever it takes to get the building into the state where you can use it. And so things you want to be aware of when you're negotiating a lease like this is that if it's allowance based, you want to make sure that the allowance that's allocated to you, that then you're going to be paying for in your lease term, in your lease payments, doesn't go toward things like common areas, so new carpet in the lobby, or or replacing the lobby doors or the elevators or something like that. Or you don't want it to go towards legal compliance issues that should already be existing in that building, like maybe asbestos abatement or for sprinklers or hurricane or earthquake standards or anything like that. And then another thing on tenant improvements is, do your rent payments start before, during, or after the tenant improvements? And again, this is just the kind of thing that whatever the case is, that you have made some type of agreement with the landlord so that you understand what your costs are going to be and what your costs are covering. So I think that's about what I have to say about real estate leases. This certainly isn't a complete review of all the issues related to real estate leases, but these are the things that have come to my mind of things that I've encountered in the past. And so I hope you found this useful. My notes on this topic can be found at facilityscience.com/podcast. And this is number 2. And if you have questions about this topic or suggested topics or any comments for me, you can reach me by email at podcast@facilityscience.com. And like I said, I hope you find this useful, and thanks for listening.